Welcome to another BAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over BAR Area 1. This is Section B2. This is an application topic. Calculate the cost of capital for a given financial scenario. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. And after you watch that, you're going to want to learn more, so make sure you also check out becoming a SuperfastCPA Pro member. Pro members get access to a lot of great stuff, including the Pro course, where Nate explains in detail exactly what you're supposed to be doing every day to pass the exams. It's kind of like a much more in-depth version of the 1-hour webinar. And Pro members also get access to the full versions of these MCQ walkthrough videos. So in today's video, we're only going to be going over 5 questions for the YouTube version, but SuperfastCPA Pro members will get access to the full 10-question version when we post it in the members forum. So if you like this and you like our other products, make sure you check out becoming a Pro member to get access to the full versions of these videos. Now with that, let's dive straight into the questions for this video. All right, here we are at question 1. One thing I always like to point out as we're getting into these questions is you want to read the last sentence of the question first. That is a very good habit to be in, especially for test day, because you have no idea what you're going to be seeing on the exam. So it's good to be in the habit of reading the last sentence first, because frequently it gives you context for what the question is about, for what you're supposed to even be doing in the question, and that will help you move through questions more quickly. So let's do that here. Based on this information, what is the company's cost of common equity? Let's go up to the top. A company wants to calculate its cost of capital. The risk-free rate is 3%, the expected return on the market is 8%, and the company's beta is 1.2. The company is not issuing new shares and will use retained earnings to finance part of its capital structure. Okay, so again, based on this information, what is the company's cost of common equity? Now, if you know how to do this, that's great, but most likely you have no idea what this is even talking about, which is why you're watching this video. So if that's the case, that's fine. We're going to go to the explanation to start learning about it right now. All right, here we are at the answer. C, 9%. That is the cost of the common equity, and this has to do with cost of capital. So let's go through this. To calculate the cost of common equity, which is also the cost of retained earnings in this case, by the way, when no new shares are issued. So you may potentially see on the exam or in your review course, cost of retained earnings or cost of common equity kind of used interchangeably depending on the situation. And the reason that they can do that is because if there are no new shares issued, then cost of common equity and cost of retained earnings are the same thing. So again, to calculate the cost of common equity, we use the capital asset pricing model. And you may have heard of that before. It's also considered the CAPM. The CAPM formula is cost of equity equals the risk-free rate plus beta multiplied by the market return less the risk-free rate. So to do that right here, to calculate the cost of equity, we take the risk-free rate, which is 3%, and that was told to us up here. We add the beta multiplied by the return on the market less the risk-free rate. So here's the beta, here's the return on the market, and here's the risk-free rate again. So once we do all that together, it's 3% plus 6% or 9%. So that is the cost of common equity in this question. And that actually flows into something that we're going to do further in the video, which is called the weighted average cost of capital. So we will get to that soon here. Because the company is using retained earnings instead of issuing new shares, there are no flotation costs, which basically means, again, there's no costs to issue new shares. In this case, the cost of retained earnings and the cost of common equity are considered the same. Both represent the return required by shareholders for purposes of weighted average cost of capital, or WACC, or WACC, however you want to say it. They are treated interchangeably unless specifically told that new equity is being issued. Again, you may see those two interchangeably used, the cost of retained earnings and the cost of common equity, if there's no new shares being issued. Now, this is one piece of calculating the total cost of capital. Now let's go to the next question. All right, here we are at question 2. What is the company's weighted average cost of capital? Let's go up to the top. A company has the following capital structure: equity of $600,000 with a cost of 9%, debt of $400,000 with a pre-tax cost of 5%, and the company's tax rate is 25%. So what is the weighted average cost of capital? Again, if you have no idea how to do this, if you don't know how to calculate the weighted average cost of capital, then that's okay. That's the whole point of doing these questions. Now, we did learn how to do one piece of this in the previous question, or at least something similar. So if you want to give this a try, that's great. If not, though, that's okay. We're going to go to the explanation right now. All right, here we are. The answer is A, 6.9%. That is the weighted average cost of capital in this case. So let's walk through it. First, the first step is we have to figure out what the total capital is. Total capital is the equity plus the debt. So $600,000 plus $400,000 gives us $1 million of total capital. Now, we also have to figure out the weight of the equity and the weight of the debt compared to the total. And that's pretty easy. You just take the equity, which is $600,000, divided by the total capital, which is $1 million, and that gives you 60%. Same thing with the debt. Take 400,000 divided by $1 million gives you 40%. So equity has a weight of 60%, debt has a weight of 40% in this case. Now that we know that, we have to adjust the debt for taxes because equity isn't going to be taxed in the same way that debt is going to be taxed. So we have taken into account the tax rate of the company to figure out the cost of debt. After-tax cost of debt equals the pre-tax cost of debt, which was 5%, multiplied by 1 less the company's tax rate. So 5% multiplied by 1 less 0.25 gives us 3.75%. That is the after-tax cost of debt. So we had the pre-tax cost of debt, which was 5%, and now we have the after-tax cost of debt, which is 3.75%. And that's the amount that we're going to multiply the cost of debt by. So let's go down here. The weighted average cost of capital is you take the equity weight, which is 0.6 or 60%, multiplied by the cost of equity, which is 9%, and then you add that to the weight of debt multiplied by the after-tax cost of debt. So all you're doing here is, again, multiplying the weight by the cost percentage, adding it together, and that gives you the weighted average cost of capital. So again, 60% multiplied by 9% is 5.4%, and 40% multiplied by 3.75% is 1.5%. So add those together and that gives you 6.9%. That is the weighted average cost of capital. Now, again, this is just the way that you calculate it. You figure the weight out of the debt and the equity, multiply that by the cost, and you have to take into account the after-tax cost for debt, and that will give you the weighted average cost of capital. And we'll kind of expand on this a little bit more throughout the video, so don't worry. So that's how you do the weighted average cost of capital in a simple way. Now let's go to the next question. All right, here we are at question 3. What is Caris Corp's overall cost of preferred stock? Let's go up to the top. Caris Corp has 2 classes of preferred stock outstanding. Class A preferred stock pays a $6 annual dividend and trades at $100 per share. There are 3,000 shares outstanding. Class B preferred stock pays a $4 annual dividend and trades at $80 per share. There are 5,000 shares outstanding. So what is the overall cost of preferred stock? Again, this is something that we have to figure out in trying to figure out weighted average cost of capital. So this is just one piece of it. We're trying to figure out the cost of preferred stock. We kind of did some of this in question 1 and a little bit of it in question 2, but not very much in question 2. So if you want to give this a try, that's okay. If not though, if you don't really understand what's going on here, that's still okay because again, we are using these questions to learn these concepts. So let's go ahead and go to the explanation right now. All right, here we are. The answer is B, 5.4%. That is the cost of preferred stock in this case. So again, we're kind of applying some of the stuff we learned a little bit in the other questions. Now we're applying it in a different situation and learning a little bit more. So let's go through this. First, we have to calculate the market value and cost of each class of preferred stock to then be able to figure out the cost of preferred stock in general. So for Class A stock, we know that the dividend was $6 and we know the price is $100. So the cost of that preferred stock is 6% because dividend $6, price $100. You divide the dividend by the price and that gives you, again, the preferred stock percentage or the cost percentage. And then we take the market value, which is $3,000, multiply that by the selling amount, and that's $300,000. So Class A is a 6% preferred stock or gives 6% preferred dividends and has a market value of $300,000. Now let's go to Class B. Dividend $4, price $80. So you take $4 divided by $80, that gives you 5%. So Class B is a 5% preferred stock or 5% preferred dividends. And then you calculate the market value the same way that you did before, 5,000 preferred shares multiplied by $80, and that's the selling price per share, and that gives you $400,000. So the market value for Class A is $300,000. The market value for Class B is $400,000. So the total preferred equity as far as the value is $700,000. Now we can figure out the weighted average cost of the preferred stock. So again, we have to figure out the weight of each of the stocks. So 300,000 divided by 700,000, that's Class A, and that would give us the weight of it. But in this case, we're going straight to then multiplying it by the preferred dividend, which is again the cost. So 300,000 divided by 700,000 multiplied by 6%. And then the same thing for Class B, 400,000 divided by 700,000 multiplied by the 5% dividend or the cost. And so that gives us 0.4286 multiplied by 6% plus 0.5714 multiplied by 5%. And then we take those two percentages and add them together. And that gives us 5.43%. Now, out of the options, none of them were 5.43%. So the closest one means that we round down to 5.4% for these answer choices. This question teaches that when a company has multiple classes of preferred stock, you must calculate the cost of each class separately, weight it by its market value, and then combine the results to determine the overall cost of preferred equity. So again, just to make sure that that's clear, for each dividend separately, we figured out the cost by taking the dividend amount divided by the price. And then we also took the market value of each of them by taking the amount of shares multiplied by the selling price. And then we were able to use that to figure out the weighted average cost of the preferred stock in total. And again, it was 5.4% there. And so this is something similar to what you would be doing when you're calculating the full weighted average cost of capital in total. So this is one piece you'll have to do, which is, again, calculating the weighted average cost of preferred shares, but you'll probably also have to do it for common shares and potentially for some debt, because we've been talking a lot about equity so far. So again, that's how you do another piece of the weighted average cost of capital. Now let's go to the next question. All right, here we are at question 4. Which of the following best explains why this change could lead to a higher weighted average cost of capital? So which of them is going to explain it? Let's go to the top. Canton Corp has historically maintained a balanced capital structure, but recently increased its use of long-term debt relative to equity to finance expansion. As a result, the company's debt-to-equity ratio has risen sharply, so they have a lot more debt than they had before compared to their equity. So let's go through these different options. Normally, I only do this when there's like word options. If it's just numbers, then I don't usually go through the options, but let's go through these. Option A, the company's interest payments on debt are no longer tax deductible, increasing the cost of debt. Option B, the increased use of debt reduces the company's total capital base, making equity more expensive. Option C, the increase in debt directly reduces the market value of equity, increasing the weighting of equity in the weighted average cost of capital. And then there's option D, higher debt levels increase financial risk, which can raise the required return on both debt and equity. So again, which one of these would be the reason that when they have a higher debt to equity ratio, that means that the weighted average cost of capital also goes up? So based on what we've learned so far, you might be able to figure this out, but if you still have no idea what's going on, that's okay. We're going to go through the explanation right now. All right, here we are at the answer. D, higher debt levels increase financial risk, which can raise the required return on both debt and equity. So let's go through this. While debt is generally cheaper than equity, partly because of the tax shield on interest payments, adding too much debt increases the company's financial risk. So if you have too much debt, it starts being risky. This added risk can lead both lenders and shareholders to demand higher returns to compensate for the increased likelihood of default or instability. As the required return on debt, which would be the cost of debt, and required return on equity, which would be the cost of equity, rise, the overall weighted average cost of capital can increase, even though the firm is using more debt, which initially seems like a cheaper source of capital. This illustrates that the benefit of debt has limits and that a rising debt to equity ratio does not always reduce weighted average cost of capital. So just to, again, reiterate that, weighted average cost of capital is you trying to figure out how much it costs to have the capital that you have, to have the equity that you have. And if you are having too high of a debt to equity ratio, if you're getting too much debt, if you're too highly leveraged, then the people who have debt with you or the shareholders who have equity might start wanting higher returns because things are riskier because you have a lot more debt. And that is going to potentially raise the weighted average cost of capital because it costs more because of the returns that people are expecting, again, because of the risk. So that's one more aspect of the weighted average cost of capital that I wanted to teach you there. Now let's go to the next question. All right, here we are at question 5. What is the company's weighted average cost of capital? Okay, let's go up to the top. A company is evaluating its weighted average cost of capital based on the following capital structure. They have total capital of $1 million, common equity of $400,000 with a cost of 12%, preferred stock $300,000 with a cost of 8%, debt with $300,000 with a pre-tax cost of 5%, and the company's tax rate is 30%. So again, what is the company's weighted average cost of capital? Now, we've done most of these things throughout the video in different pieces and in different ways, so you might have somewhat of an idea how to do this. If you want to give it a try, definitely pause the video and try to work your way through this. And when you're ready, come back. We'll look at the answer together and make sure that we understand how to calculate the weighted average cost of capital in this more complete question. So again, when you're ready, come back. All right, here we are. The answer is C, 8.25%. That is the weighted average cost of capital in this situation. So let's take some of the things that we've learned throughout this and kind of reapply it here. So the first step, we have to determine the weight of each of the capital components. So the common equity, $400,000 out of 100, $400,000 out of $1 million, 40%. Preferred stock and debt both are $300,000 out of $1 million, so they're both 30% separately. Step 2, now we have to adjust the cost of debt for taxes. So because we have debt, we have to adjust for the taxes, so we have to figure out the after-tax cost of debt. So we take the cost of debt before taxes, multiply it by 1 less the tax rate, and that gives us 3.5% as the after-tax cost of debt. So this is the amount that we're going to multiply the debt weight by. So let's go ahead and finish this up. Again, it's not too difficult once you know what you're doing here. So you apply the weighted average cost of capital formula, which is again the weight of the common equity multiplied by its cost, and it gave it to us up there 12%. Then you add the preferred stock's weight multiplied by the 8% cost, and then you add the weight of the debt multiplied by its after-tax cost, and again we're doing the after-tax cost there. So you do all those together and then you add it up, and that gives you 8.25% of weighted average cost of capital. And again, we're just trying to figure out the cost of the capital that we have. So we have common equity, we have preferred stock, and we have debt. Those all have a cost. So each piece of the capital has to be figured out separately to figure out how much of the weighted average cost of capital is attributed to each of them. And then you add it all up together to figure out the total weighted average cost of your capital. The weighted average cost of capital reflects the average return the company must earn on its investments to satisfy its investors, considering the cost and proportion of each capital component. The cost of debt must be adjusted for taxes because interest expense is tax deductible, lowering the effective cost. So again, throughout this video, we learned about calculating the cost of capital, mainly the weighted average cost of capital. We learned about different pieces of the weighted average cost of capital calculations. And with that, we've gone over 5 questions. So before we do anything else, let's do one more part of the SuperFast CPA process called Pillar Topics. Now, the idea behind Pillar Topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2 or 3 or 4 questions trying to teach you how to calculate the weighted average cost of capital in a certain situation, or maybe a few questions trying to teach you how to calculate the weighted average cost of preferred stock specifically. Whatever the case is, you notice these things throughout the questions, and as you're going, you write them out in your own words as the pillar topics. And as you're doing this each day, taking time to pull out the most important things you learned, you are building your own personal repository of the most important things you learned from the questions so that you are ready for the exam. So let's go ahead and take a look at the pillar topics for this video. All right, here we are at the pillar topics. Let's just dive straight in. First off, let's talk about the cost of common equity using the CAPM model. To calculate the cost of common equity or retained earnings, again, this is similar. We use the cost of equity equaling the risk-free rate plus beta multiplied by the market return less the risk-free rate. That's a specific calculation or equation that you're going to want to remember when it comes to the cost of common equity / the cost of retained earnings. Now let's talk about the cost of preferred stock. The cost of the preferred stock is calculated as the annual dividend divided by the market price per share, and that will give you the cost of the preferred stock that you can then multiply by the weight of the preferred stock when it comes to the total capital. And you could figure out the weighted average by you doing that. If there are multiple preferred classes, calculate each separately and weight them by market value. Now let's talk about the after-tax cost of debt. Because interest is tax deductible, the cost of debt must be adjusted. So the after-tax cost of debt is the pre-tax cost of debt multiplied by 1 less the tax rate. Now let's talk about the weighted average cost of capital formula. And this is with full names. This is everything that you would need to know how to do this. And again, we did little pieces of this throughout the video, and then we did it more fully at the very end. So you take the equity divided by total capital, and then you multiply it by the cost of equity. Then you add the preferred stock. And by the way, equity is most likely common stock. Then you do the preferred stock and divide it by the total capital, and you multiply it by the cost of the preferred stock. And then you add that to the debt divided by the total capital, and you multiply that by the after-tax cost of debt. Don't forget that with debt, if you are paying attention to the tax costs, you have to multiply the weight of the debt by the after-tax cost of the debt. You don't have to do that with equity, but you do have to do that with debt. And then finally, let's talk about how debt affects the weighted average cost of capital. Using some debt can lower weighted average cost of capital due to the tax benefit. So if you have just a little bit of debt, but too much debt increases financial risk, which raises both the cost of debt and the cost of equity in the long run, and that would increase the overall weighted average cost of capital as well. So with that, we've gone over everything that we needed to go over in this video for the YouTube version. Remember, for the YouTube version, we're only doing 5 questions and the pillar topics. So if you liked this and you like our other videos, make sure to check out becoming a SuperFast CPA Pro member, because you'll get access to the full 10-question versions of the video when we post it in the member forum. So if you want to get those full versions, again, become a Pro member. And the easiest way to learn about and become a SuperFast CPA Pro member is by going to SuperfastCPA.com and signing up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. So check out the webinar and check out becoming a Pro member. If you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.